Good morning, everybody. My name is Regina Crandall, and I am the Small Business and Employment Resources Librarian with St. Louis County Library. If your business needs capital, a business loan is generally the most reliable source of financing. Interestingly, though, banks only approved around 13% of business loan applications last year, down from 28% in 2019 and close to 50% pre-COVID, which makes getting a business loan all the more competitive. So navigating the world of business loans can be tricky, especially for the first time. This is why it's important to get organized and anticipate what is required during the process. If you're considering financing, this information presented today should arm you with all of the tips you need to prepare for the loan application for your small business. First, I'll define the 5 characteristics of creditworthiness. We'll look at the many tasks you can do and should do well before starting a loan application, and then review what lenders are looking at exactly to determine the creditworthiness of a small business applicant. So lenders typically look at the 5 C's, the 5 characteristics of creditworthiness, to help determine the creditworthiness of a business and the person applying for financing. Let me say this another way. Unless your business has been established for a long time and is no longer considered small, lenders are looking at the creditworthiness of the person or people applying for the loan. So the 5 components include capacity, capital, collateral, conditions, and character. I wonder if I can get this there. So we're going to review the 5 C's and then talk about the sources that provide the details and how you can prepare to meet these criteria. So capacity is your ability to repay the loan. So lenders will evaluate your personal and the business's financial capacity to repay the loan as well as operating expenses. How exactly do lenders determine your ability to repay a loan? They're going to look at your primary source of repayment. They're going to consider what other potential cash flow sources there are. They're going to look at your projections and the projections that forecast your business's financial standing into the future and budgets. They're going to look at your payment history to date. They're going to look at your debt to income ratio. They're going to look at your debt service cover ratios. Next is capital. Now, capital is the personal money invested in the business. Your business may own capital assets such as cash, equipment, or real estate that can be used to support your credit application. You and others, maybe partners or investors, have already invested funds in the business too, so equity is also an important consideration for a lender. The amount of capital assets and equity you have on hand says a lot about your prospects for receiving financing. Basically, lenders like to see that you have skin in the game. So invest as much cash in the transaction or business before applying for a loan. So collateral are assets that can be used as an alternative repayment if you can't repay the loan. Accounts receivable, inventory, cash, equipment, and real estate are all examples of forms of collateral, and they are all assets lenders may accept as security for loans. When estimating the value of your collateral, a lender will look for liens, which is existing debt owed on that collateral. The existence of a lien may disqualify the collateral as a supporting asset for the loan. This is because the lien holder has first claim on that asset in event of a default. Just having assets is not enough for a lender to accept them as collateral. They are also going to consider these other issues. The quality of the asset. What is the condition and value of it? Marketability. How easily can it be sold? Availability. How movable is it? How accessible is it? Assignability. How easy is it to transfer ownership from one party to another after the loan is repaid? Intangibility. Physical assets versus intangible assets, which are like accounts receivable or intellectual property. Conditions. This is additional information that can influence the lender's approval. many of which you have absolutely no influence over or ability to control. The state of the economy, industry trends, and pending legislation relative to your business are all conditions that are considered by lenders and factors in the evaluation of your loan application. So current market conditions include something like what's happening in your industry, what's happening in the local market, how is your industry affected by inflation, employment, and regulations, to name a few. The type of loan and its various components like length, interest rate, and payment terms greatly affect your loan approval. Average business loan interest rates can range from 6 to 350%, depending on the line, the type of loan, and the lender. So just the interest rate alone can make a difference on whether or not the business can afford a debt payment. Feasibility. Does the business need money for a project that is financially viable? What is the likelihood that that project or idea will succeed? And similarly, we have the sensibility of loan usage. Does your need for a loan make sense? Are you asking for funds that support your business? Can you clearly define your need and that need is a function of your business? Are there any legal or physical limitations or barriers that prevent you from using loan proceeds? For example, are you looking for a construction loan, but you haven't even acquired the land to build on? Are you looking for startup costs in the cannabis industry, but aren't even licensed to sell? These are barriers. And lastly, there's the element of risk. Lenders are not gamblers. They are not risk takers. So you'll have to demonstrate that you will use their money successfully. Through the loan application process, you will have to prove that you are not a risk, that your business is not a risk, that lenders can be assured of your ability to repay a loan. And lastly, we have character, and that is the general impression that you make on the lender. They will take into consideration your business management capabilities. What are business and industry experience do you and your business partner or management team bring to the table? Just because you have a great product or service does not make you a responsible or capable business owner. I mean, look at how many business or companies have failed due to poor or inexperienced management. They're going to look at your personal credit history, your personal integrity and good standing, basically your reputation, and the integrity and standing of those closely tied to the business are of utmost importance. Your willingness to communicate candidly with your lender about opportunities and challenges your business faces are key to a productive financial partnership. Hiding, downplaying, or being ignorant of financial standing are not good signs of good character. Truth be told, blatant misinformation during the loan process is fraud. So please be transparent with your lender. So what and where exactly are lenders looking to determine your credit worthiness? This thing is just in the way. I'm sorry. So we're going to delve a little deeper into all of these components. Let's get this out of here. I'm going here. Okay. We're going to talk about these things you can do before you apply for a loan and what is required as part of the loan application process. Before you consider applying for a loan, there are a number of things you should do to be prepared. Build and repair your credit, organize your business, create your business plan, educate yourself on business loans and compare lending options, and finally decide why you need financing, how much you need, and how much you can realistically afford. So let's look at each of these tasks individually. This is driving me nuts. So lenders rely on your personal credit score to evaluate the credibility of your business and your trustworthiness as a borrower. It tells lenders if you pay your bills on time, open too many or too little credit lines, and how you utilize debt. The catch-22 is that to get a loan, you'll need to demonstrate a history of repaying loans on time. So this means you'll often have to start out small. If you're a brand new business that's only been around a few months, then you likely won't qualify for a big bank loan. However, you'll probably be eligible for a business credit card. That's because credit card companies will look at your personal credit score when determining your eligibility. As you responsibly use that card, you'll build your business credit and improve your credit utilization ratio, both of which will help you score higher, bigger, better loans down the road. So before you submit a credit application, review both your personal and business credit reports for delinquent accounts or incorrectly reported delinquencies with all major credit reporting agencies. Business credit reporting agencies include Dun & Bradstreet, Experian, and Equifax. And you can check your personal credit reports with Experian, Equifax, and TransUnion. But I've been told by numerous lenders that business credit, especially for small businesses, isn't even taken into consideration because there generally hasn't been any business credit established. So most small business loan applications are based almost entirely on your personal credit history. Everything about your business needs to be documented for proof. That includes your revenue, expenses, debts, assets. You must be able to back up every transaction and number with paperwork. Avoid waiting until the loan application time to get organized. By creating and automating your accounting and bookkeeping practices now, you'll make the loan application process smooth, easy, and accurate. If you don't know where to start, bare bones bookkeeping can be as simple as Excel or Google Sheet spreadsheets. Maybe consider using a cloud-based bookkeeping tool to organize your business finances. There are actually a lot of free tools out there, like Sunrise, Wave, and ZipBooks are a few that come to mind. But there's also scalable solutions like QuickBooks that can grow as your business becomes increasingly more complicated. All of these help you manage your income and expenses. They send and track invoices. They generate financial reports, calculate taxes, and more. There is no right or wrong solution. Just do it now. I cannot emphasize enough the importance of having a business plan, and we're going to talk about this throughout. A solid business plan will convince your lender that you know what you're doing and help you prove your personal and business creditworthiness. As we discussed earlier, lenders will typically evaluate your loan application based on the 5 C's of credit. So although your business plan won't contain everything a lender needs to make that assessment, that business plan can highlight your strengths in each of these areas. So when a lender assesses your character, they review your education, business experience, and credit history. That review also extends to board members and management team. So the executive summary, company overview, and management team sections of your business plan can highlight those strengths. Capacity centers on your ability to repay the loan. So lenders will be looking at the revenue you plan to generate, your expenses, cash flow, and your loan payment plan. So the funding request and financial statement sections of the business plan can highlight your responsible financial history. So capital is the amount of money you've invested in the business. Lenders use it to judge your financial commitment. So you can highlight your financial commitment in the operational plan, the funding request, and/or financial statement sections. Conditions refers to the purpose and market for your products and services. So lenders will be looking for information such as product demand, competition, and industry trends. These details should be addressed in the market analysis, products and services, and marketing and sales plan sections of your business plan. Collateral can be highlighted in several sections. Anything that shows assets, such as the operational plan, the financial statements, or even in the appendices. So business plans do not just benefit lenders. A formal business plan gives you a better idea of why you need financing, how much you need, and how much you can afford. This document will also help you decide if a loan is even the option needed to achieve your business goals, or if you can meet your business needs with operating income. Lenders want to loan money to borrowers they can trust. Do your research and learn the basics. Educate yourself on business loans. So demonstrating knowledge of business loans will help build confidence with your lender, which increases your odds of getting funding. So after you determine why you need financing, decide what type of loan you need. So the loan amount, use proceeds, timing, and creditworthiness will all impact which type of loan you need and qualify for. So here are a few popular loan types to consider. A business credit card works much the same as personal credit card. You use your credit card to buy now and pay later. Like I mentioned earlier, it's a great way to expand your available capital and build your credit score if used responsibly. So SBA loans are small business loans guaranteed by the Small Business Administration and are among the most sought after business loans. They can include the 7A loans, 504, cap lines, microloans, and others, each of which serve different purposes. SBA loans often have large lending amounts, competitive interest rates, generous repayment terms, and more flexible down payments than other options, but you'll often need to be an established business to qualify. And they're challenging to qualify for and notoriously paperwork heavy, but they're the best financing available for small businesses. APRs generally range like 11 to 15%. Term loans are traditional installment loans that can be repaid over predetermined terms. Banks, credit unions, and online lenders all offer these loans. And while some have limited uses, many can be used for most business-related expenses. There are long and short-term loans. Short-term loans are just faster and more expensive. You'll face higher interest rates and shorter repayment terms, but you'll get the money in the bank more quickly. So APRs tend to range from 6 to 99%. So a business line of credit is a form of financing that your business can draw from a predetermined limit on an as-needed basis, making it a good option for ongoing cash flow issues. When you use your credit line, you'll only pay interest on the portion you borrowed. Once you repay the borrowed funds, then you get access to the capital again and no need to reapply. APRs can range anywhere from 10 to 99%. So accounts receivable, also known as factoring, financing lets you trade your outstanding invoices for immediate cash. So when factoring, your business sells outstanding invoices to a factory company at a discount. This can be an effective way to get paid for outstanding invoices quickly rather than waiting for customers to pay. So if you just need extra money to cover a slump or to pay your own bills, factoring may give you all the financing you need. APRs tend to range from 10 to 79%. Merchant cash advances works by giving a lender a portion of your future sales, making this a good option for businesses that have high volume of sales and need cash quickly. So basically, you're trading tomorrow's earnings for cash today. Your lending will provide you with a lump sum of money, and you'll repay with a percentage of your daily or weekly sales. APRs range from a whopping 45 to 350%. Equipment financing funds the purchase of equipment and machinery, right? So these loans can be used for any asset purchase, and the terms can be as long as 25 years, and APRs range from 4 to 45%. So you need to decide if you really need a loan or if your main issue is related to cash flow. And your business plan can help you determine your current and future financial situation. This graphic shows examples of the reasons that businesses have applied for financing. And you can see it includes establishing a business or business expansion, buying new equipment or inventory or real estate, paying for day-to-day operations or marketing initiatives or payroll. So how do you decide which loan is best for your situation? The right type of loan depends on, I'm trying to move this everywhere, depends on what you're hoping to accomplish. So this comes back to the why you need a loan. Your business plan will help you determine why you need financing, which will in turn help you choose the right kind of loan. So let's look at a few common scenarios. Say you want to fund a startup or start a business. Since most lenders have minimum time and business requirements, it can be tough to find one that will issue you a startup loan for a new business. If you're just starting out, you may have to apply for a microloan or a business credit card. You may find it easier to qualify for a business card because it is based on your personal credit. Personal business loans and lines of credit can be good options if you haven't been in business long enough to qualify for a line of credit or a term loan. Traditional term loans are lump sums that if you want to finance a large purchase or a business expansion, you might want to consider it a traditional term loan, since they are lump sums that you pay back over time with interest and often have the highest borrowing maximums. For example, did you know the SBA has loans that can reach $5 million? So many lenders also offer specific products to fit a growing company's needs, such as loans for equipment or vehicle purchases, in which the asset is the underlying collateral. Do you need to pay for day-to-day expenses? So a working capital loan or a short-term loan used to cover daily expenses can help you cover temporary cash flow problems. This flexible kind of funding lets you tap into capital as you need it to cover expenses such as payroll or unexpected repairs. So it offers basically a useful safety net. If you need to borrow a small amount of money, consider a microloan. A micro is like a $50,000 loan. They're small. Okay. Before applying for a business loan, it's important to determine how much money you need. So getting a loan of more than you need could cost you unnecessary accumulated interest on top of prepayment penalties. Requesting less than you need may require you to go back for a second loan or leave a project unfinished, both of which are avoidable with a little research. So get accurate estimates before you speak to potential lenders, because attempting to borrow more than your business can afford is a red flag to vendors or lenders. So lenders may also question the application if you don't borrow enough for your demonstrated need. So consider seeking advice from your accountant or banker on how much to borrow. Once you know how much you'll need, start considering how much you can realistically afford. Look at your revenue and expenses and ensure that you can afford an additional payment. If not, you may need to adjust your loan amount or loan type. For example, while you might not be able to afford a short-term loan, you could still qualify for a merchant cash advance or a business line of credit. Crunch the numbers and then review your options again if necessary. There are so many options, there's no reason to feel like you're stuck with one. Importantly here, don't wait until you need a business loan to start applying. Plan ahead. If you foresee a future financial need, consider getting a loan in advance so that you're not stuck in a long application process while your business is scrambling for cash. It's especially important if you operate a seasonal business with regular cash flow fluctuations. Consider a line of credit to cover any potential slow periods. As you consider the different funding types for your business, consider how quickly you need to receive your funding. Each loan option will have different turnaround times once you submit an application. And if you need your funding quickly, some options are better than others. Many loans, including loans from banks and credit unions, typically take at least 30 days or longer. To make things more complicated, in addition to the type of loan, you need to choose the type of lender. Although the type of loan may very well dictate which type of lender will work with your situation. So here are some statistics that show where small business owners have applied for financing. This is in 2001. So you can see where most of them apply for and some of the options available. Oops. So you'll typically want to get a business loan that offers you the best terms, but other factors may matter to your business, and different funding sources may be better in certain circumstances. So every lending institution is different. Large banks can provide big loans, but they're often preoccupied with enterprise clients, the big clients, and have strict eligibility requirements. Alternative lenders usually provide quick approvals and more lenient requirements, but they compensate for the risk with slightly higher interest rates. Local banks may be your best bet because they allow you to meet in person, develop relationships, and potentially earn some flexibility. Basically, there's no one-size-fits-all lender. You need to do your research and shop around. Choosing the best business loan comes down to comparing loans you qualify for and determining which loan is the right fit. So as you shop for loans from various vendors, consider using a business loan calculator to calculate the cost for each loan. This can help you lower cost financing options. So these are some of the factors you should analyze when shopping for loans. The APR, the annualized percentage rate, represents what the loan costs on an annual basis, including interest and fees. By comparing the APRs can give you an apples to apples idea of which business loans would be the most and least affordable. Lenders may charge upfront fees to process your loan application. So projecting these fees and factoring them into the equation also helps you compare costs. Terms for business loans can range from 1 year to 25 years. So choosing a long-term loan can decrease your monthly payments, but it also increases how much interest you'll pay over time. So the right loan term for you depends on your goals and what installment payments you can afford. And we just talked about this. While most business loans from major banks might provide competitive rates for borrowers with strong credit, the application process can be cumbersome. So if funding speed is a high priority, online lenders may offer faster funding. So all of those things were issues you should take care of before you consider applying for a loan. So by understanding all of your loan options and not rushing the process, you'll be in the best position to apply and get approved, as well as avoid wasting time and money. So finding and applying for a small business loan is very time consuming, but by knowing the lender's typical business loan requirements ahead of time, you can streamline the process and avoid potential frustration. Now you should be prepared to start with the loan application. We know that the lenders are looking for the 5 C's, but how do they determine your creditworthiness? Let's review each of the 7 criteria lenders look at to decide whether you qualify for a business loan. We've talked about it before. We're going to go a little deeper. Since lenders have different eligibility requirements, the personal credit score you need to qualify for a business loan varies. A good, which is 690 plus, personal credit score is required to qualify for traditional bank and government-backed SBA loans. Online lenders, on the other hand, can be more lenient with credit scores, emphasizing your business's cash flow and track record instead. So some online lenders and micro lenders offer business loans for bad credit and will accept a minimum personal credit score as low as 500. The business credit score needed to qualify also varies from lender to lender, if it's a requirement at all. Plus, it depends on the type of loan you're applying for and what business credit score a lender uses. So for example, when it comes to SBA loans, you'll typically need a minimum business score of 155 to pass the SBA's pre-screen process. However, most lenders set their minimum score requirements between 160 and 165. But remember, unless your business has been established for some time and you're not even considered a small business anymore, lenders are not looking at the business credit score. Okay, I'm going to try to get this out of the way. Okay. So many lenders will consider businesses that meet minimum monthly or annual revenue requirements, meaning lenders look at your revenue to make sure that you make enough income to afford your loan. So how much cash flow you'll need depends on the type of loan. Term loans typically require at least $100,000 in annual revenue, while a line of credit may only require $36,000 in annual revenue. How much cash flow you'll need also depends on the individual lender. For example, online lender OnDeck requires $100,000 in annual revenue to qualify for its line of credit, while Bank of America's minimum is $250,000 for its secured business loans. So when looking at your annual revenue, lenders are also considering your cash flow and evaluate how much you can afford to apply towards your loan repayments every month. So the debt to income ratio, which compares your business total debt payments to your gross monthly income, and the total service cover ratio, which compares your available operating income to your current debt obligation, they're literally backwards of each other, are essential indicators to your business's financial health and the ability to take on additional debt. So generally, lenders want to see a ratio of higher than 1, typically a minimum of 1.2, as this indicates that your cash flow is sufficient to cover your debt obligations. So some online lenders require daily or weekly repayments, so make sure to factor that in. You'll need enough cash flow to make the payments when they're due. To qualify for a business loan from a traditional lender, you'll typically need to have been in business for at least 2 years. Online business loans tend to have less stringent requirements, but still usually require at least 6 to 12 months in business. Lenders specializing in startup loans often require only 6 months in business, and certain loan types, like equipment loans, may have no minimum time in business requirements. But again, criteria vary by lender. So lenders also take into consideration the type and size of your industry. Every industry has a different risk level, and certain industries like restaurants or beauty services, for example, can be considered high risk because they're more likely to have inconsistent revenue. There are also certain industries that lenders do not work with at all. These typically include adult entertainment, drug dispensaries and products, gambling, or money service businesses. Government-backed loans from SBA come with very specific requirements. So if you want to qualify for one of those, you have additional boxes to check. You must meet, for example, their definition of a small business, which varies by industry. You must be a for-profit company, so nonprofits cannot apply for an SBA loan. You cannot operate in an ineligible industry like real estate investing, gambling, or political lobbying. You must be current of all government loans with no past defaults. That includes a federal student loan or a government-backed mortgage, for example. A comprehensive and well-written business plan can be used to persuade lenders that your business is worth investing in and hopefully improve your chances of getting approved for a small business loan. We discussed the various components of a business plan that apply to those 3 C's that demonstrate your creditworthiness, but they should also demonstrate that you have enough cash flow to cover ongoing business expenses and new loan payments. A great business plan, a comprehensive business plan, will give the lender more confidence in your business, which increases your chances at loan approval. At the end of this conversation, we're going to go deeper into business plans so I can show you how to actually do those. The lender will ask for every seemingly imaginable financial and legal document related to your business, and many from you as well. And they can include, you can see the lists here: personal and business tax, income tax returns, personal and business financial documents, P&L or income statement, balance sheets, cash flow statements, personal and business bank statements, and the list goes on. Be prepared in advance to give these documents to your lender. Now, online lenders may provide a streamlined application process with fewer documents and faster underwriting. Truth, if you're not sure what you need in advance, although this is very comprehensive, Start with the SBA application. Just look at those requirements. Since they are so paperwork heavy, if you have everything that's required in those, you will be very well prepared for whatever any lender asks for. Oops, let me try to get this. Let me put this over here. That's annoying, isn't it? Okay. Lenders base their decision to lend to you or not based on your level of risk. If they aren't confident they will get their money back, lenders won't invest. So collateral helps lower that risk by providing banks with a guarantee in case that you default on your loan. So some lenders may require that you put up collateral to secure your loan. So you should provide information about the type of collateral you're offering and be prepared to answer all of those other aspects of collateral that we went over earlier. It can be helpful to get an independent appraiser to value that collateral before applying for a business loan. Banks and SBA lenders are more likely to require collateral than online lenders. Most lenders offer unsecured business loans, which don't require physical collateral, but will likely still come with a personal guarantee. Other business owners may be required to sign a personal guarantee as well. So some lenders may require both collateral and a personal guarantee. For example, the SBA 7A loans above $50,000 typically require collateral plus a personal guarantee from every owner of 20% or more of the business. Lenders may also take out a blanket lien on your business assets, essentially another form of security, but it gives the lender the right to take any business assets, real estate, inventory, equipment, to recoup an unpaid loan. So basically, every lender has its own rules, so ask questions of your unsure. You're unsure. As a small business owner, you wear a lot of hats, but sometimes it's best to delegate some of those responsibilities and focus on what you do best. Don't be afraid to ask expert advice. Bookkeepers can help you keep your financial transactions neat and tidy, while accountants help you with your planning, projections, and the applications. An attorney can review your loan agreement to ensure that you understand what you're committing to. Always establish a relationship with your banker and consult them on your financial affairs, especially before going into the loan process. So basically, professionals can help you discover these opportunities and raise red flags when there's an issue they know lenders will be concerned about. So the final step is to submit your small business loan application. Depending on what lender you've decided to work with, you may be able to do this online or in person. Once your business loan application is approved, you'll receive a loan agreement from your lender. It will lay out all the terms and conditions, including loan amount, repayment terms and schedule, interest rates and fees, among other things. Please review this agreement thoroughly, sign it, and return it to your lender. At that point, you'll get your funds and generally directly into your business bank account. So making a mistake in the application process could prove costly to your financial future. So some of the best practices to keep in mind include: anticipate the 5 C's of creditworthiness: capacity, capital, collateral, conditions, and character. Get your financial affairs in order well before needing a loan and starting the application process. Think like a lender. Once you've completed your loan application, review everything from a lender's perspective to ensure you've provided everything they would want to see in order to approve your loan. Your application is your chance to prove yourself as a competent borrower. It's your resume, if you will. So be prompt and thorough. If a lender requires additional documentation, send it as soon as possible. Lenders review many loan applications, and prolonging the application process may affect their decision to approve your plan. Provide more relevant information than what the bank asked for, if you can, so you can avoid delaying the process by having to provide additional documentation. Be accurate. Like applying for a job, padding your loan application may negatively affect your chances of getting a loan. Lenders want to work with borrowers they can trust. So review your financial documents carefully to ensure they accurately reflect your business's finances, its earnings, and growth potential. That was a lot of information to help you prepare for the loan process. Now, given the importance of a business plan in the loan process, I'd like to dig a little deeper. How do you go about starting a business plan? Maybe you've never even seen one to understand what all of this information even looks like. Thankfully, the library has some great resources that can help you visualize what one looks like and resources to walk you through how to prepare one. So First Research provides in-depth industry analysis necessary for business plans. So the details include industry forecasts, SWOT analysis, financial information, and insights with industry executives. I'm going to show you what it looks like. First, that's not true. I am going to show you first how we access all of these. All of these would be accessed the same way. So I'll show you once, and then we'll go back to it. This is our website, slcl.org. Okay. All of these you hit right to research and learn. If you scroll down here to resources A to Z, these are alphabetized. So each of the resources I'm going to like their letter, and then I'm scrolling down. So you can see how they're alphabetized. So we were just talking about, First Research, and this is what it looks like when we get there. So I'm going to choose one to show you some examples. We're going to go to bowling centers. I'm sure one of you out there is wanting to do a bowling center, right? So we are researching this industry. This information shows up in multiple aspects of your business plan. We're looking at a full profile. Sorry, it's thinking. Okay, so it comes down here. It shows you exactly what is happening in your revenue, or I'm sorry, in your industry. Remember, we talked about that that's one of the conditions that they are looking for. It describes here the competitive landscape, the products, technology, and operations. We've got some great graphics if that's something you want to include in your business plan. So it's not like you're making up the information you're putting in your business plan. You're doing legitimate resources or research. And this is one example of where that research can come from. Okay. I hope I'm not scrolling too fast. They cover different aspects of the industry, sales and marketing, finance and regulation, international and regional highlights, HR. Remember, we talked about how does employment affect your industry? This explains it. Here's your industry growth rating. A lender might be very concerned if it was down here and in a risky situation. So if it is in a positive place, you put that in your business plan. You're trying to sell yourself. Industry indicators, forecasts, drivers. This is your SWOT analysis. What are your strengths, weaknesses, opportunities, and threats? Okay. Putting this information in your business plan addresses all of those 5 C's for your lender, and also shows your level of competence. Executive insight. This is like picking up a phone and talking to these high-level executives in the industry to see what they feel is happening. So that when you're explaining in your business plan, it's not coming from you, it's coming from others, their opinion, not just yours. CIOs, HR, sales. And we come down here, and this is just a different version of that. Okay. So this is an example of where to get research for your business plan. But what if you don't even know what a business plan looks like? I'm going to show you a few. We're going to go into this one called B plans. We go here. There's a lot of going to resource. We're coming up here. So B plans offers over 500 sample business plans. These are organized by industry. Let me get rid of this. But you can look at any that appeal to you. So let's go look at a few examples. Let's go to auto repair and car wash. Let's just see what one looks like. When you come over here, it is going to encompass all of these functions that a business plan has. Not only do you see what it's going to include, look at how detailed it is. It shows the executive summary. It goes on and on. It shows, whoa, let's come up here. What did it show? Startup summary. Shows exactly where you intend to be financially. Details about your products and services. Details about your personnel. Okay. Down to pennies. Your service, it talks about your details for your competitors. It talks about your industry, trends, forecasts. You remember seeing some of those in that first research database? It gets right down to everything. Lenders eat this up. This is why your business plan is so important, not only for them, but for you. Analyze the market, because you're trying to justify how you're going to make your money, your strategy, your plan. Okay, so this is just an example. Let's go to one that's maybe simpler. That was very, very detailed. And it doesn't have to be detailed. Let's start a bakery. Let's start a bakery. Let's come down here, see if we can find one. Ooh, here's a bakery business plan. Look it over here. See how much shorter it is. Maybe this version is easier for you to start with. There is no right or wrong. You just create something that works for you. I mean, look at how much simpler it is. It doesn't have to be complicated as long as you are addressing all of the issues. So this is an example of a business plan. This database can help you find those. Okay. Gale Business Entrepreneur is another it covers all aspects of starting and operating a business, including accounting, finance, HR, management, marketing, tax. But for this conversation, it has sample business plans. Let's just put, oops. Oh my gosh. Sorry, I am just having a day. And it likewise gives you sample business plans. So maybe it depends on which of the databases you prefer. But they're all here. Ooh, let's go to this one. This is a cat sitter one. This is kind of cool. So it shows you here what it's going to cover, and you can see here what it looks like. And once again, you can see it's covering a lot of that same information. How they present it and what level of detail is entirely up to you. But this is just another database that can help you with your business plan. Okay, we're going to go into tutorials. So whereas B Plans and Gale Business showed you what the physical plans look like, LinkedIn Learning and Udemy can teach you how. Okay, so we're going to go into LinkedIn. I'm actually going to go down here. This here. LinkedIn Learning and Udemy offer video courses and tutorials of various lengths and levels of experience if flexibility and self-paced learning are your preference. So I've chosen business plans as a topic here, but you can choose specific topics that help you with your business plan, like market analysis or industry research. So this is what LinkedIn Learning looks like. If you're in LinkedIn and you try to do some of their learning through LinkedIn, it will cost you. If you do LinkedIn Learning through the library, it is free of charge, as is all of this information, free of charge with your library card. So Udemy also has, it's the same thing. So we're going to go into one of these and look how to write a business plan. Oh, and just so you know, Udemy, after a certain amount of time, will close you down, which is okay because safety. That's up to that. So here's one. They just look different. Sometimes it's just the way the information look, what appeals to you. So we're going to do the same thing here. Business plans. You can see we have over 2,800 results. Let's just come down to one. Okay, so notice here, right here, the course includes, in this case, 9 hours of on-demand video, articles, downloadable resources. You can access it on your phone, and this is great. You have the certificate of completion when you're done. That gives you or maybe a potential employer or even your lender maybe some satisfaction. So let's come down here so you can see what more it looks like. We have details. It has the bio of your instructor, which is great because in my opinion, a lot of people might YouTube this information, but there's legitimacy in the information gotten from received from databases. Okay. So it explains everything. Okay. I just want you to see. We have the course content, instructor bio, your ratings. Okay. That should give you some degree of comfort about the information. So lastly, but not, I acknowledge this is a lot of information that I'm trying to highlight. If you would like to book a one-on-one appointment where we can go over these and any library resources, I recommend filling out Book a Librarian. Okay, so you come in here and basically we will schedule a one-on-one appointment to meet you when and where is convenient for you to discuss what you want to discuss. You just put that in here. Okay. Book a Librarian, can't go wrong. So I am going to come out of here and look at chat. I apologize. Yes, I'm going to send out the information later. Can you repeat the 3 different bookkeeping websites? You can just do a Google one, but let me repeat those. I'm sorry. I think it's my Monday times 2. Sunrise, Wave, ZipBooks. And they're free. So that's a great opportunity to experiment, especially if you're new to organizing your information, your financial information. Okay. So I'm going to be sending out the slides. I would like everybody, there's my contact information. I recommend, giving us a call. I recommend that Book a Librarian. Is there any other information I can help anybody with? Love this. I know it's a lot. I feel like I'm just spurting. Oh, yes. So Sunrise, Wave, ZipBooks. Okay. Does anyone have any questions whatsoever? I am going to stop sharing. I'll even put on my video. There you go. I am a live person. Will I be offering any more classes on nonprofit? Interestingly enough, I just had a few about nonprofit financing. If you want, Lisa, I can send the slide presentation for that one. If you're talking about financing, would that help you? And if it does, put in your email address for me. Yeah, I'm going to try to do the recording. Are you talking about that, Nicole? Are you talking about the nonprofit one? It's coming. I apologize. So I will get you those. Did you all want both the nonprofit one as well as this bank financing one? Okay. Okay, great. I can send that out as well. That's all I have. I know we're hitting our time criteria here. Does anyone have any other questions other than I will try to get you not only the recording, which is what I'm waiting for on that other one, and the slides to these. Like I said, it was a lot of information. I appreciate your patience. But if nobody has, when was it a good idea to start building business credit? Before you need it. If you have like your LLC or your sole proprietor, I recommend going down to the bank and getting a credit card and starting there. Opening your business banking account, you're starting there. And when you start to use that, you're developing that credit. Okay. But remember, your personal credit is kind of critical. Not just, yes, Mercy, I got it. No, the business credit rating, the credit score. But the business credit score isn't taken into account, but your your financial activity is, if that makes any sense whatsoever. Because eventually you will get bigger. Eventually you will outgrow, your barriers of time served and annual revenue. And so they'll be looking at that. So your business score is consistently building in the background. So you want to make sure that you are building it. Whether they look at it or not is on them. If that makes any sense. Okay. I think I got everybody. I don't know if any bank account takes, I don't know if any bank account takes small business, but have business account. Now, bear in mind, you're probably going to have to go to a local bank. And when you open your business bank account, you're going to have those documents. You're going to have to, your articles of incorporation, your tax ID numbers and stuff like that. I recommend starting with a bank that you have a personal account at. This is not a good time. This is not a good way for online banking because you need that personal relationship. So I would recommend starting there. Does that help? Okay. Okay, everybody. If that's the case, then I'm done. You hopefully have my contact information, and I will look forward to the next class for this exact information is next week. If if you feel a need to redo it, it's on Thursday, April 11th from 6 to 7 in the evening, so it's not during the day. So that's what I have. I also ask all of you, or maybe you're not aware, but we have a annual business conference, and we're going to be covering a whole litany of nonprofit and small business topics. That is the first few days of October. So please look at our website so you can see that information. We will be covering these topics repetitively, okay? I appreciate all of your feedback. And maybe I will see you all again in the future.